I know you've probably asked yourself this question before. If charts don't lie, then why are so many people losing money? Well, the truth is, most people don't lose money because the markets are dangerous. They lose money because they misunderstand what they're looking at. So if you're one of the millions of people who've ever felt like markets are confusing or unpredictable, like prices move for no reason, or like everyone else knows something you don't, this video is for you. Because here's the simple truth. Charts don't lie, but people do, especially to themselves. In this video, we'll show you why charts tell the truth and why so many people still lose money even after learning how the market works. When I first started in crypto, I had the same misconception. I thought there was someone out there controlling the price, that every move was planned and every loss was unfair. But I was wrong. Because when I began to truly understand how markets work, I stopped chasing moves and reacting emotionally. I stopped blaming the market and started taking responsibility for my decisions. And that's when things began to change. Now, before we get started, if you haven't subscribed yet, please hit the subscribe button. And if you're completely new to how markets like crypto or stocks work, I've put together a beginner-friendly playlist that breaks the basics down step by step. You can check it out after this video. Now, why do people lose money in the market? The number one reason beginners lose money is the belief that the market prices are decided by someone. Some people believe prices are controlled by a small group of powerful players or insiders. You might be wondering who these big players or insiders are. Big players are individuals or institutions with enough capital to influence price movement, while insiders are people who have early or privileged access to information before it becomes public. One thing these large players often have in common is scale. They deploy capital in the hundreds of thousands or even millions of dollars at a time. Now, when people see large transactions like this, they often assume price manipulation, when in reality, size alone doesn't explain market movement. This is where mindset comes in. When beginners see large transactions or headlines like this on social media, they develop the misconception that anyone with a lot of capital automatically has the power to control the market. Because of this, when the market moves against them, they don't look at the decisions they made that led to their losses. Instead, they start looking for someone to blame. That's when you start hearing things like, "This market is rigged. Nothing here makes sense. This is just gambling." But here's the truth most people don't want to hear. The market isn't out to get you. Prices don't move because someone woke up and chose a number. They move because of human behavior, such as fear, greed, patience, and panic, all playing out on a chart in real time. Let me give you an example. Whenever the U.S. Federal Reserve is about to cut interest rates, the moment it becomes certain, human behavior changes. Traders start buying in anticipation. Prices begin to move before the announcement, and by the time the news is officially released, the move is often already on the chart. Smart people who understand the importance of news already knew when to enter and exit the market. By the time beginners start asking why or what triggered the move, the market is already turning in the opposite direction, and that's when they begin to react emotionally. That's why, when you don't understand market structure, everything feels like chaos. You start to believe the chart was manipulated, but that's not manipulation. That's expectation and reaction. I know someone might ask, if charts aren't manipulated, then what do charts actually show? The simple answer is that a chart is simply a record of human behavior. Think of it like you standing on a busy road during rush hour in the morning. You're not predicting where each car will go. You're just observing behavior. When the road is clear, cars move fast. When there's an accident or bad weather, drivers slow down, hesitate, or change routes. The road itself isn't random. It reflects how people are reacting in that moment. A chart works the same way. It doesn't guess the future. It shows how people are responding, like when they're confident, when they're scared, when they're rushing in, and when they're pulling back. Every single candle on a chart represents real decisions being made in real time between buyers and sellers. When more people are willing to buy at higher prices, the candle moves up. When more people rush to sell, the candle moves down. That's how emotions show up on a chart. Now, Fear appears when people start selling because they're afraid of losing more. For instance, during a market downturn, when prices are already trending lower, many traders rush to sell, not because the chart suddenly changed, but because fear takes over. They believe the market will sell off soon, maybe due to news of war or tariffs. In essence, they're not reacting to structure anymore. They're reacting to emotion, and that emotional reaction is what appears on the chart as strong red candles and sharp price declines. This fear can sometimes escalate into panic, which shows up when people start selling aggressively just to get out. In situations like this, prices drop sharply and crashes happen fast. Those who didn't exit on time end up selling at the worst possible moment, not because the chart told them to, but because emotion took over and the need to escape became stronger than logic, and that panic is written clearly on the chart. But fear isn't the only emotion influencing decisions. What about greed? Greed shows up when you start hearing things like, buy now before it hits a certain price. This is often triggered by online hype and FOMO from social media platforms like X. You see others celebrating profits and feel pressured to jump in, not because there's any strong reason driving the rally, but because you don't want to be left behind. Everyone wants to benefit from the move before it's over, and that urgency is exactly how greed shows up on the chart. Prices start rising faster as buyers chase the move, and in the end, some people lose money, not because the market was unfair, but because greed pushed them to enter very late, buying at the top and selling at the bottom at a loss. However, in all of this, there is patience. And that's where smart traders and investors stand apart. Instead of reacting to every move, they wait. They observe. They allow emotions like fear and greed to play out before making a decision. And this brings us back to the bigger picture. A chart isn't showing you magic numbers or secret signals. It's showing you how people are behaving. Once you understand that, charts stop feeling confusing and start making sense. So when someone says, charts don't work, what they're really saying is, I don't understand what people are doing, because charts don't move randomly. They move because people react to expectations, to fear, and to what they believe will happen next. And once you understand that, charts stop looking like chaos and start looking like a story. Now that you understand charts move because people react, let's break down the specific behaviors that create those emotions in the market. Well, they're usually not complex strategies or advanced indicators. They're simple, everyday reactions. For example, imagine you walk past a store and see a sign that says, last 2 items left. Even if you didn't plan to buy anything, urgency kicks in. Your heart rate rises and you feel pressure to act fast. That's exactly what happens in the market. When price starts moving fast, people feel the same urgency. They rush in because they're afraid of missing out. When price drops sharply, fear takes over, and they rush out just to feel safe again. In essence, they enter the market without a plan and exit based on emotion. They don't lose money because the chart was wrong. They lose because they entered late, exited early, and blamed the market instead of their decisions. This is why 2 people can look at the same chart. One loses money and the other wins. Same chart, but different mindset. So, if you don't understand the structure, the market will feel like gambling. And that's because gambling is all about reacting without understanding what is happening. You place a bet, hope for the best, and accept whatever outcome comes next. There's no framework behind the decision, just emotion and chance. Markets are different. It's not about guessing, it's about responding with context. It's about understanding why the price moved, where buyers and sellers are likely positioned, and what conditions are influencing their decisions. When that context is missing, every candle feels like a surprise. A move up feels lucky. A move down feels unfair. That's exactly how the market works. When you don't know why the price moved, where liquidity is sitting, or who is likely buying or selling, the market feels unpredictable. Not because it truly is, but because you're only seeing part of the picture. And when you're missing the full picture, your brain fills the gap with fear, doubt, and emotion. That's when you start thinking things like, if I can just find the right setup or the right signal, I'll finally win. At that point, you start jumping from one idea to the next, from one strategy to another. But what most people don't realize is that every jump comes with a cost. Small losses add up. Poor timing compounds. You end up buying high and selling low. And sometimes the moment you exit, the price moves back in the other direction. That's when the real frustration kicks in. You start thinking something is wrong with you. You replay your decisions, blame the market, and feel stressed, confused, and emotionally drained. I've been there. I still remember the Q2 2021 crypto rally, precisely May 2021. I was in this exact position. I jumped from one coin to another, convinced it was the fastest way to make money. When I saw my portfolio drop massively, I moved from one crypto exchange to the next, thinking the solution was always somewhere else. At a certain stage, I even chased newly listed coins, believing they were the quickest path to profit. But I was wrong. By the end of my journey, my portfolio had dropped from $2,000 to $100. Not because crypto didn't work, but because I was constantly searching for shortcuts instead of understanding what I was doing. Outside of crypto, I've seen the exact same story play out in other markets. Someone buys after a big move, panic sells on the first pullback, then watches price recover after they're already out. In essence, the market doesn't reward shortcuts. It rewards patience, the ability to wait. It rewards discipline, the ability to follow a plan even when emotions are high. And it rewards understanding behavior, knowing how people react and why price moves the way it does. Remember, the market doesn't punish ignorance, it exposes it. And that exposure feels painful because the market reflects your decisions back to you in real time. This is why mindset matters in the market, not motivation. Not hype, not confidence built on hope. So what's the lesson here? Smart traders don't rely on charts alone. They combine charts with news. They follow the news to understand what is happening, why it's happening, and how people are likely to react to it. More importantly, they have a clear strategy. They know when to enter, when to stay patient, and when to exit the market, and they stick to that plan. For example, some people exit the market once the price drops below a major level or zone. Not because the market is against them, but because that level represents a change in behavior. Their plan tells them that if the price breaks that area, the original reason for the trade is no longer valid. That's discipline, not fear. When you combine charts, news, and a clear strategy, the market starts to make sense. You stop thinking charts are lying because you now understand why the price is moving the way it is. And this is what really matters: the ability to wait when nothing is clear, to observe without rushing, to control emotion when price moves against you, and to accept uncertainty instead of fighting it. Because the market will never give you certainty, it only gives you information. And how you respond to that information is what separates consistent traders from emotional ones. Now you know that charts don't lie. Remember, this video is not financial advice. It is only for educational purposes. Investing involves risk, especially when decisions are made without understanding or a clear plan. Always do your own research before investing. Do not invest what you cannot afford to lose. If you find this video helpful, like, share, and subscribe. Thank you.